Hi, Sanjay. Hi, Mo.
Hi.
Brilliant. Well, look, thank you all for joining. I think we'll get started now because it's bang on 2 o'clock. So appreciate you all joining, and as always, welcome to our Market Insight webinar. Those of you who don't know, my name is Thomas. I assist Mo on the research side here at Carrington. As we all know, we have Mo, our head of investments, and delighted to say and welcome Sanjay Rigstikani, who is the CIO and founding partner of LGT Wealth Management. Those of you who don't know, LGT manage over 22 billion for private individuals and institutional clients. I thought how we would start off this webinar is, first of all, I'd give you guys an introduction of what we're going to talk about. So we're going to give a summary and recap of Q1 2023 and everything that entailed, because it was a busy quarter with lots going on. We're going to discuss current topic of inflation, which has been on markets and topics for quite a while now. We'll look at how central banks are responding to that ongoing fight with inflation, and also the global growth outlook, both for developed markets and also emerging markets. We'll then go on to talk about the outlook, and Mo and Sanjay will give their thoughts on strategy moving forward. And then we'll finalize that with portfolio changes and changes we've made for the Carrington portfolios, and also we'll do a Q&A for anyone who has any questions. It's not often we get Sanjay on a webinar, so if you do have any questions, we would encourage them, and we will do our best to answer them. But before we get into the nitty-gritty of the quarter recap, Sanjay, I thought it would be great for the audience and for listeners if you could just give a brief introduction about yourself and how you got to where you are today.
Thanks, Tom, and a very good afternoon to everyone. I'm sure the listeners don't want to hear about my journey, but very, very briefly, I've been in the industry over 30 years, and I sort of fell into it by accident. I was due to join or take up a role at Shell. I sort of graduated as a chemical engineer, and one of my uncles was a big bridge player, so he took me to an event one Friday evening, which wasn't ideal for me because I was a chauffeur, and Friday evenings you want to go out there, enjoy it with your friends. But nevertheless, I went to this party with him, and I met one or two individuals that were setting up a fund management organization, and that's how sort of conversations began. And I ended up taking up a role at their new organization, which then became a part of Brewin Dolphin. Some of you may have heard of the name Brewin Dolphin. It's a large private client organization. From Brewin Dolphin, I moved to Lang & Cruikshank, which is Credit Agricole. From Credit Agricole, then sold the division that I was involved in to UBS, and I moved into UBS. Primarily on the private client side, and then from UBS, a few of us in 2007, 2008 decided we needed something a little bit different from your large investment banking model, and we set up an entity called Vestra, which is now known, as you rightly said, Tom, LGT Wealth Management. So there's a little bit about my journey, but it's now over 30 years.
Well, thank you for that, Sanjay. Thank you. And I thought I should also clarify for those of you who aren't aware, the relationship between Carrington and LGT. So Sanjay and the team at LGT help assist us on the discretionary service that we offer for clients. I appreciate not all of you will be on that service, but they allow us to provide the discretionary service for you. So I guess as I mentioned, we'll try and do a quick recap of 2023, the first quarter, and what happened there. And I think it was, mostly dominated, I think, as Mo and Sanjay, you can probably both agree with, is this continuing fight that countries have had with inflation, and how central banks have tackled that with the interest rate policy. We saw a rather positive January, coming into this year, which I think which surprised a lot of people. And I think, but then when you look at February, it was quite the opposite, and markets, started to price in higher inflation and the fact that perhaps central banks were going to continue hiking interest rates, which is a headwind for equity markets. So you had that continuous volatility from January and February, and into March, where you were then sort of delighted with sort of a mini US regional bank issues. As I'm sure many of you saw on the headlines, there were sort of some issues with those banks there, and were quickly sort of abated by support that the Federal Reserve in the US provided. And then, as I'm sure as many of you are also aware, that then sort of led to, or it was then sort of became that Credit Suisse then had issues. But again, I think Mo and Sanju, those issues were underlying for quite a while. But I think the main key from March was that this wasn't a contagion risk. I think that's what central banks really wanted to make clear by providing that support. And so that's sort of has been the current view for Q1 2023. And I think coming into April this year, the month has been dominated by inflation again, and we've got this back and forth between the two camps. We currently now are in a situation where central banks across the globe do have higher interest rates. Inflation is easing in the US, unfortunately not so much in the UK, but we're generally seeing tighter financial conditions. So I guess given where we are and the kind of quarter we've had so far, and the year we've had so far, Sanjay, I thought I'd ask you the first question of whether you thought the Federal Reserve does have space to raise rates from here, and perhaps what your view more generally on the kind of macro environment was currently.
Sure, thanks, Thomas. Yeah, I mean, do they have room to raise rates? Absolutely, they can go as high as they want. At the end of the day, they've made it very clear to us over the last 15 months that their mantra is that short-term pain of higher rates is a lot less than long-term pain of higher inflation. And I think as long as inflation continues to remain above their 2.5% target, I think they won't refrain from carrying on their aggressive strategy. There was a little bit of a doubt a few weeks ago when we saw the banking crisis, and you rightly alluded to, SVB and CS, and there were a couple of other smaller US regional banks that collapsed. But in the main, not only were those banks or the depositors made good very quickly by central banks, we started seeing things normalize a lot faster than some had hoped. So the fact that the US has moved away from ensuring and giving us confidence the banking system is fine, they've moved their approach back to raising interest rates. There's every reason to believe that we will have a rate rise in the month of May, 25 basis points. If you look at the bond market, there's an 85% probability of that happening. So it's quite high, but I don't think we're far from the peak. So I do believe that we will see a pause. Where views differ depending on which organization you represent or you read about is whether we will see rates beginning to come off towards the end of this year. And that's going to be very much data dependent. The beauty of the last 14-15 months is that despite one of the most aggressive hiking cycles in history, the global economy has proved to be quite resilient. Saying that, we must accept and appreciate that there are long and variable lags. So if rates started going up this time last year, you would normally expect it to start inflicting pain by now. But that hasn't yet happened. The labor market continues to be tight. The consumer continues to be very resilient. We've seen retail sales continue to rise. But that's not to say that the future won't bring pain, depending on when people have to remortgage, depending on when the bond market sees a refinancing cycle happen. The higher borrowing costs will undoubtedly impact certain sectors, certain parts and segments of the market. And what I'm trying to say is that when you go through the most aggressive hiking cycle in history, the only casualty is not going to be SVB. The only casualty is not going to be the cryptocurrency, which is now actually trading back high above 30,000 when you look at the Bitcoin. There will be a little bit more blood on the streets, but it's not unhealthy that. It's painful at the time, but we do want these business models that have become so used to running businesses with 0% inflation, 0% interest rates, that now that the climate is a little bit more normalized, these are the businesses that will probably struggle, moving forward. The final thing I'll say, and then pass on to Mo if I may, And that is, for a whole decade, we had Christmas, free money, cheap money. And that climate is now well behind us. And at the same time, that was a period when we would look at markets, we would look at it as one entity. So whether you're looking at the US or Europe or Asia, there wasn't much difference in terms of policy. We all had very similar policy, i.e., bond buying programs going on, cheap inflation, interest rates are very, very close to zero. But that dynamic has changed quite dramatically. I think you mentioned, Tom, that inflation in the US, pricing pressures are coming off. They will come off because it's very easy to control inflation there. You raise interest rates, they're a self-sufficient economy, they have enough energy, so they're not hostage to overseas forces. So as the high lending costs bite, you will see price pressures ease. But Europe and the UK, very different dynamic. You could raise interest rates here and there might be a shock, an external shock that takes commodity prices higher, and there's nothing you and I can do about it. We will see inflation continue to rise. So it is quite a tricky climate for policymakers to maneuver through. And then you have Asia, which is a very, very different environment right now where inflation is not a concern. Certain emerging markets raised interest rates a couple of years ago. They were very, very swift to act. And right now, because of China, Asian inflation has not really, spiraled out of control. If anything, we're seeing economies like China coming out of a lockdown, injecting stimulus, and they're probably very close to phases that you and I witnessed when we were coming out of lockdown. It's a very different dynamic. So, for our listeners, it's very important to note that, the style of money management has changed materially over the last 18 months. And we also have to accept that going forward, whilst interest rates will be peaking very, very soon, we will be in a climate where arguably inflation is returning to norm, which is 2.5% to 4%, and interest rates will also remain more elevated than what we've been used to over the last decade or so.
Sure. I think, Mo, we've spoken previously internally about sort of our view that, as Sanjay mentioned, the SVB issues, and those are sort of potentially only small tremors to what may lead to a slightly bigger earthquake in terms of global economic outlook and growth. And so, yeah, again, good to hear your thoughts as well.
Yeah, sure. Of course, Sanjay gave a very comprehensive answer there. But as you said, SVB and Credit Suisse, etc., they're probably not going to be the only casualties, and it's very likely that we will see other issues sort of crop up down the road. And I suppose just back to the sort of question about, interest rate policy, and as again, Sanjay mentioned, I think what's been quite fascinating and the amount of volatility we saw in the bond markets over the last about just over a month ago when the SVB issues crept in, and the markets were very aggressive in pricing in interest rate cuts from the Fed pretty quickly. And I was asked at the time if I thought that the Fed would cut interest rates, and I thought that the chances are they probably won't do, for the reasons Sanjay mentioned, which is that their primary function, which is to tame inflation, had not been achieved so far. So therefore, logically, they were likely to continue with their interest rate cycle and path that they had set out. So, but again, I agree with Sanjay that I think we're probably near the peak now, and I wouldn't be surprised if after the next hike we saw a pause, and they allowed the hikes that have already been put through to take effect effectively. And again, Sanjay mentioned about the delay of the hikes that we've seen so far, and I think it's surprised many people that we haven't seen the effects just yet. A lot of the economic data has been stronger than expected. So yeah, probably not much more to add than that. I think Sanjay gave quite a comprehensive answer there.
Yeah, well, both of you do. So yeah, thank you for that. And I guess then thinking about financial markets, Sanjay, where does this sort of put equity markets and fixed income markets? Because if we do see the Fed hike rates one more time, as you mentioned, and then potentially pause, what impact could that have on both the equity markets and the bond markets?
Well, it's all about what the bond market has got priced in terms of the terminal rate. And I will tell you that whilst the bond market is a very good gauge of where interest rates will peak and where they're heading over the next sort of 12 to 18 months, the bond market's been wrong for 18 months on the trot. So it hasn't exactly been something to follow where historically it's held quite true. I think it's very important to note that last year, when we saw the decline in both bonds and equities, double-digit declines, which hasn't been seen for about 60, 70 years, was primarily because when your risk-free rate goes up, asset prices have to adjust. And in this particular instance, of course, they adjust lower. If our listeners were getting 4% in the bank, which they probably are now, they're not going to invest money with ourselves if we're going to give them 2 or 3%. We can't go out there and buy bonds for our clients yielding 1%. We can't go and buy equities growing at 2%. We certainly can't go and buy property providing rental income of 3%. So something had to give. And last year was that transition year. As we speak right now, the market's got rate cuts priced in towards the end. As Mo and I have just mentioned, we're very, very close to the peak. Now, there is a risk there that pricing pressures continue. The labor market proves very, very resilient, and some of the wage increases that are being talked about, that a lot of our listeners are reading about, whether it's in the public sector or the private sector, if they start going through, those pricing pressures won't disappear that quickly. So there is a risk that rates go a little bit higher than of course what the bond market is telling us, and there is a risk that we may not see rates come off towards the end of this year, because you and I as consumers may prove to be quite resilient. So those risks we have to take into account. But as things stand right now, we're probably entering a phase where markets are beginning to react to good news as good news. So just for our listeners, over the last year or so, if it's bad news, the market feels that's great, because that means rates won't go up, so the market tends to go up. And if it's good news, the market thinks, oh my God, that's bad news for the stock market. So we see stocks tending to fall, because that means rates will go up. But the last month or so, we're beginning to see the positives of good news, that maybe the global economy is strong enough to withstand higher rates, and we may not go down the recessionary path that some had predicted this time last year. I mean, how many pundits out there predicted a deep recession in Europe and in UK this time last year? Has it materialized? No. Natural gas prices have halved. The UK economy here has proved to be a lot more resilient, and we haven't seen the recession that's being talked about. And if you ask me to put probabilities on various outcomes going forward, outcome number one, a deep recession, I'll say 33%. Outcome number two, a soft landing, I'll say 33%. And outcome number three is that we grow, again 33%. So I can't stick my neck out in the current climate, because I'm looking at the same data that you're looking at, that central banks are looking at, and right now things are proving to be stronger. So this time last year, the outlook was, probably a 70% chance that we'd have a deep recession, 30% chance of soft landing. Now you can clearly see the outlook scenarios have been diluted, with a view the soft landing continues to rise as a potential positive outcome.
Yeah, I mean, as you referenced there, I think that sort of shows how fast sort of markets are moving, and as I alluded to at the start, month to month, there always seems to be a different sort of outcome priced in. So I think your answer of equal probability to each one is a good one. But Mo, I thought I'd come to you and just sort of asking, given how markets are moving so quickly, and we do see these changes so often, how do you manage those changes?
Yeah, I think to Sanjay's point about not sticking your neck out at the moment, I think that's probably the best course of action, because, again, Sanjay referencing the different probabilities of what we saw maybe a year ago, or the expectations were a year ago and what they are now. And Sanjay's placing an equal probability to each, which basically says that it's very difficult to predict what the outcome is going to be at the moment, and it can take any which path. So, you could potentially made a good case for owning banking stocks and the financial sector a few months ago, due to the high interest rate environment. But, I think they're the sorts of things that we were trying to avoid doing, and just trying to keep it as contained as possible, and not having sort of any biases in any particular direction, because the chances for some issue turning up, and issues turning up in the future still remain quite high. So yeah, I think that's really been the key for us, is just trying to keep it contained, you know, not take any sort of off-piste bets, and you know, but effectively don't stick your neck out anywhere really. And I think that's worked very well for us in the sort of recent past.
Just to add, may I add a point to both valid points there? I mean, you know, we are coming from a climate where we now have options. So Mo's absolutely right. There's no need to go out there and take excessive risk when, well, for one, cash is giving you 4%. Two, you and I both know we can go and buy high quality bonds giving 5%. We never had that luxury for a whole decade. So there isn't any need to go out there and take material risk. And if you stick to your knitting and continually expose portfolios to those businesses that have pricing power, you know, strong balance sheets, wide economic moats, you know, sort of oligopolistic, monopolistic type characteristics, you know, you're not taking too much risk, and arguably those are the businesses that will survive at the end of this, irrespective of what the hiking cycle looks like this time next year.
Sure. Okay. And given that then, because you know, I'm sure a lot of our listeners and ourselves as well, last year we saw a lot of headlines saying, you know, a 60-40 portfolio is dead, and fixed income is not sort of providing any sort of protection as we historically saw. You referenced there now that you're able to get access, and you know, bonds are back in vogue. So do you still see a scenario where the 60-40 sort of equity bond portfolio can still perform now that we're sort of out of that period where, as you mentioned earlier, equities go down and bonds go down because of the macro environment?
Yes, absolutely. I mean, you know, it's bizarre because, I mean, let's be under no illusion that the 40% of that 60-40 is what historically has been exposed to the bond market. And whilst over the last decade you'd only have 40% exposed to the bond market with the view that it'll provide you with a great cushion in case there is a war or any other political uncertainty or a pandemic, there wasn't actually providing a return, it was providing you with a protection. Today, we have the luxury that it provides you with a return, but let's be under no illusion that that return will beat bank rates or it will beat inflation. And that's why we do need equities in the portfolio. It is the equity segment of our client portfolios that arguably will keep pace with inflation. And if you can buy a Microsoft that has the ability to raise the cost of its goods and services and tools to you and I by the rate of inflation, that's a great hedge against inflation. Same applies to MasterCard, to Visa, but the bond market for once does provide certainty of cash flow, which is key. So we're now in an environment that we can go out there, we can buy bonds, giving our clients 5% or so return and higher, depending on where we position ourselves on the credit spectrum. And there's a certainty of cash flow there, but that cash flow doesn't necessarily beat inflation. If inflation remains at 7% for the next 2 years, you know, bonds are not going to beat it, but they're giving you good cash flow. And the same with bank rates. Bank rates might go to 6 and we're buying bonds giving us 5 today. It may not beat the bank rate, but at least you're not far short from it. So it's quite an interesting dynamic. And you know, the 60-40 portfolio over many years has worked really well for all of us, for all our clients. Last year was an anomaly. I would like to stress that last year should in no way be seen as a template for future years. It was an anomaly year where asset prices had to undergo this transition, you know, the repricing of assets because your risk-free rate went up so quickly. And the fact that risk-free went up so quickly, all prices had to debase. From here on, I think that debasement, the bulk of it is taking place. What arguably our clients are now looking at from our side is to make sure that we are in the right areas. And if you take away last Jan and Feb, the reality is markets have been sideways to slightly up. So as long as you've been in the right sectors, you've done quite well, both on the bond segment and on the equity side. I mean, the bond segment, let's not forget March a few weeks ago, Credit Suisse going under, resulted in a huge amount of volatility in what we call the AT1s. That's a segment of the bond market that didn't get paid out. From our perspective, we look at that and say it's crazy that, you know, the authorities here in the UK and the US said that normally the AT1s will get paid out before any equity holder gets paid. So we went out there and you could buy these bonds yielding 10-11%. They've all rallied double digits since then, and that's what, you know, you'd expect us to do, to take advantage of certain mispricing in the market. But that doesn't take away the fact that the last year was a transition year. It wasn't mispricing. They had to be repriced as your risk-free rate went up.
Okay. Thank you both for that. Yeah. I thought the next thing we could talk about is talking a little bit about global growth. Sanjay, at the start, you mentioned sort of potential opportunities in China and Asia specifically, and also in the emerging market regions. And I think what we've seen, or what sort of institutions are predicting is that you will see developed markets come under a lot more pressure from a growth perspective versus the likes of China and India and other emerging markets. Can you perhaps give your overall picture on the growth outlook for both developed markets and also emerging markets?
Sure. I mean, there are a lot more risks today to, I guess, developed markets versus Asian/emerging markets, which hasn't historically been the case. Like I said, we treated the world as one for a whole decade, and now that dynamic has changed. For starters, let's look at energy. I mean, energy is a key driver of markets. It's a key driver of economies, and it has a massive impact on growth within each economy. You've got the US, which is energy self-sufficient, so they don't rely on other sources. You've got Europe, which is heavily dependent on overseas forces. And then you have Asia, in terms of mainly China and India, which are the biggest importers of energy. Now, because of the war this time last year, and because of the relationship the West has with some of the oil-producing nations, we tend to buy oil something like 25-30% higher than what China and India pay for it. So clearly you can see that right now they have a competitive edge when it comes to energy costs, which has a direct impact on margins and everything else that one looks at. So for the very first time in history, China and India are buying oil 30% cheaper than what you and I are paying for it. So there's one tick in their box. The second tick is they're not facing the same inflationary issues that we are. And I said that a few minutes ago. They did not have the same policy response to COVID that we had over here. Now, hindsight tells us that giving people money whilst they're sitting at home is going to lead to hyperinflation, and that's what we've seen over the last 12 months. That never happened in the likes of Asia. Yes, there were various things put in place, various tools put in place, but paying people £2,000, £3,000, £4,000, £5,000 a week or a month for sitting at home, that did not happen there. They don't have that welfare state capability, and arguably that's what's posing the inflationary issues today. They again don't have those issues, and then it boils down to valuations. I mean, arguably the clients are looking for us to buy assets that are cheap, that are mispriced, and when you're looking at Asian assets, emerging markets assets, it's quite easy to find companies on P's of 8 to 10. It's quite easy to find businesses that are trading below book value, and that's exactly what we want to incorporate within these portfolios. But recognizing that there are political risks out there, we cannot ignore the fact that the relationship between ourselves and the West versus China continue to deteriorate. I don't see that getting better. You cannot ignore the fact that there is a war going on and that might worsen. You cannot ignore the fact that China may decide to invade Taiwan one day. So, these are factors that we constantly discuss, and we ask ourselves, the worst case scenario happens, how would it impact asset classes? But in the main, if one's looking top down, you'd have to say that Asian markets, commodity producing markets, are trading at levels that are quite attractive when it comes to the West. One final point, and I'll pass on to Mo. It was about a year ago that I saw the breakdown of the world index versus contribution to GDP. So what I mean by that is if you take the world index, the MSCI World Index, the US was roughly 70% of that index, and the US contributes 26% to global GDP. Conversely, if you look at Asia's exposure to the world index, it was about 12% ex-Japan, and it contributes between 37 to 40% of the world's GDP. So clearly there's a mismatch. I mean, how much more do you think the US is going to be as a part of the world index? And our view was, well, there's going to be some form of rebalancing that occurs. That rebalancing didn't have to take place for the last decade because, like I said, the whole world was one. You might as well then invest in the US because you get better quality, better visibility. But now that dynamic has shifted, and we have seen over the last year or so, US underperform some of the other economies in terms of stock market performance, and there is that little bit of rebalancing going on, and that might continue. And as a result, from our perspective, whilst we're aware of all the risks in emerging markets and Asia, gradually and structurally we are increasing exposure to that geographic region.
Okay, interesting. And Mo, are there any sort of countries in particular in Asia and in emerging markets that you sort of have a particular view on or are particularly bullish on?
Yeah, I think just before going into sort of country specifics, just add a point there to what Sanjay just said, which is I am certainly in the camp that I think we are more likely to see a rebalancing in the sort of equity composition of global markets. So a rebalancing away from the US towards emerging markets and other geographical regions for various reasons that Sanjay mentioned, and one of the key ones probably being valuation as well, and the different dynamics that we have, different backdrops between the DM developed markets and the emerging markets. So I'm certainly in the camp that I think on a sort of slightly longer term view that we could see a rebalancing. And it's, by the way, just I appreciate that the last 10-15 years have been dominated by US markets, and it's very easy to look back at that period and think that, well, that's just the way it's going to continue to go moving forwards. But we did see a period like that from sort of 2001 up to 2010-11 where the emerging markets outperformed the US quite materially. So I wouldn't be surprised if we did see a return to that kind of environment where there's a sort of rebalancing act. And I think we've also seen that so we do look at flows, so investor flows to different regions. And one way we track that is through the ETF investments that are happening across Europe. We've certainly seen in the last sort of 6 months or so that there's been quite a steady flow of ETF assets towards the emerging markets and out of the US. So that's quite an interesting one. And I think that could be something that becomes a bit more of a theme moving forwards. And then touching on maybe more specific, again, Sanjay mentioned the commodity exporters. So they're the sort of countries that I think I'd be quite interested in exploring and looking at on a look-through basis in our portfolios to make sure we have some good exposure there. So we are already overweight the Asia and emerging markets, and we will be looking at ways to enhance that in the sort of next 6 to 12 months.
I thought I'd pick up on one point you made, Sanjay, because obviously tensions between China and the US, and as you mentioned, China and Taiwan in the headlines. There's always sort of news about that. But how as portfolio managers and as investors, how do we actually plan for something like that or a risk like that, and can we realistically plan for something like that within our portfolios?
I think you have to be aware of it. It's a bit like the last decade where I'd be lying if I said we didn't talk about policy and politics when discussing our portfolios and geopolitics, but it had very little impact on the portfolios because we were in a benign inflationary stroke interest rate climate. But now, because of the pandemic, politics and policies associated with politics does have an impact on markets. Clearly, the amount of money that was handed out to individuals during COVID is now resulting in shifts in policy. And the same applies to geopolitics there, Tom, that we talk about various scenario testing, we model our portfolios if this was to happen or if that was to happen, but we don't actually do anything from an asset allocation perspective. We still go with our valuation tools that tell us what's looking cheap and what is looking expensive. We do try and put in hedges in the portfolio. You'd expect us to. So if we can find some form of investment that's uncorrelated to both the bond and equity market, we'll grab it with both hands. It's never easy to find, and sometimes you have to pay up for those things. But we do look at that. We do have short-dated treasuries. We're now dipping our toe in the long end. So again, these are sort of parts of this market that will do very, very well tomorrow if one of these unfortunate scenarios comes or holds true. But in the main, it's more about discussion, scenario testing than actually going out there and making portfolio changes in anticipation that sort of China might invade Taiwan.
Yeah, of course, because I guess you never know really. So I completely understand that. And I guess with increased geopolitics we've seen over the last year, one theme has been deglobalization. We've seen such an extended period of globalization, in the 2000s, and it seems to reverse now. And it's another sort of similar sort of theme we're hearing of is reshoring. Do you perhaps, Mo, perhaps I'll come to you first, actually, and perhaps you could talk about the potential impact of this deglobalization on perhaps China, as we've been discussing, and emerging markets more generally?
Yeah, sure. So I think the sort of reality, and obviously Sanjay might have his views here, but I think the reality is that there's been a lot of media coverage of this and the sort of fallout between the US and China. But I think the actual sort of process is going to take a very long period of time. So if I'm not mistaken, I think that China and the US had a record level of trade with each other over the last sort of 12 months or so. So I don't think it's actually coming through yet in the data, but there's lots of noise around it. And clearly there was some article today about Apple and how they're diversifying their supply chains to India. So it's going to take a long period of time, but naturally there are going to be sort of winners and losers from this over the sort of coming many years. And one of those is probably going to be Southeast, or parts of Asia and Southeast Asia, where they're going to become the sort of beneficiaries of the diversification away from China by the developed markets, and particularly the US. So they could potentially come out as winners from this. And then I suppose the other point is, about the inflation side of it, because clearly if a lot of these economies, especially the US, are bringing more of the production onshore, that's likely to be inflationary over the sort of longer term. So, the sort of average levels of inflation for us, I think we're expecting them to be on average higher than they have been in the last 10, 15 years. One of the reasons being this phenomenal reshoring, and another one being the race to net zero. So, clearly the whole sort of ESG story and becoming moving in line with the Paris Agreement, I think it's also going to create a lot of inflationary pressures moving forward. So I'm sorry, and I've diverged it, but I've wanted to cover those topics quickly because I appreciate we're running out of time, and maybe I can bring Sanjay in here to cover off some of those points as well.
Yeah, no, thanks. Well, I mean, pretty much agree with your sentiments there. Deglobalization is not something. I mean, the globalization supertanker can't just be reversed overnight. It's a generational thing, and the decoupling between arguably China and the US started 5 or 10 years ago, but it's going to be in baby steps. They both need one another. They can't function without the other. So that's not going to change anytime soon. When you read statistics like China controls 85% of the supply chain to do with renewable energy, clearly the West can't all of a sudden say one morning we don't need China. It's just not going to happen. But there are elements or signs of deglobalization that are happening. I mean, Intel, for example, has set up is building its first factory in the US, first time ever. It's unheard of. It's normally either in Taiwan or in China or in Holland. For them to have a factory in the US is something very, very new. So there's a clear sign. And there's also tells us that inflation is here to stay. One of the outputs of deglobalization is the prices will remain elevated. The labor force in the West cannot be as cheap as it is in those jurisdictions. But in the main, we're probably at a juncture where the media is ahead of itself when it talks about deglobalization. In reality, they can't do without one another. Mo rightly put, the trade figures clearly tell you that they're so dependent on each other, the two superpowers, and that's not going to change anytime soon. Arguably, China has the advantage that it can trade with a number of its neighbors too. So from a trade perspective, they're not solely reliant on the US. And for one final bit, China doesn't actually really care if Apple decides to manufacture its iPads in India or Indonesia. They rather Apple, or rather China, not be seen as the outsourcing hub of the world. They're very comfortable with companies and different businesses in the West looking elsewhere for their future, because China's modeling itself on the US. It wants to be a consumption-based society. It wants its own IP. The fact that they're filing more patents than the rest of the world put together clearly tells you that they have started moving in a direction where they don't want this outsourcing business. They want to expand and grow their middle classes, whereby they can have a society 20, 30 years down the road that is not only larger than the US, but more importantly, very similar to the US, consumption-based. So it'll be interesting to see how things pan out. And all I'll say to our listeners is don't always believe what you read in the press, because our press is very biased, and make sure they publish what they want us to read. And China and Asia is not dissimilar. They publish only aspects of what they want their domestic person to read.
Cool, thank you. Okay. Yes, I mean, as Mo mentioned, I think we're sort of nearing the end of our time now. So I wanted to briefly touch on, perhaps, based on what we've discussed today, both Sanjay and Mo, perhaps you could share with the listeners some of the changes you guys have been making within your portfolios, to sort of, and thinking ahead about the year ahead and what you've been doing. So maybe perhaps Mo, I'll come to you first.
Yeah, I think we made quite a number of changes, more last year than this year, I would say, in recognition of the changing environment. And some of those were very, very quick, and we were opportunistic with others. And I think one thing that we have been doing, and I probably mentioned this quite a few times, is that coming into 2022, we were underweight bonds, so we didn't really have much in some of our portfolios, and sort of from Q3 onwards, we started to bring in some bonds and more on the corporate side in Q3, and then in Q4 we brought in more of the sort of government bonds, and right now we are imminently going to be increasing our exposure to or adding to the existing positions around longer term government bonds, because I think Sanjay touched on it earlier. The risk is relatively elevated, and I think if we are in a scenario where the Fed end up pausing and then at some stage they'll be cutting, we don't know when that would be, but usually that's very positive for parts of the bond markets, especially the longer dated bonds. So that's really, I think, in a nutshell, what we're up to at the sort of portfolio level. On the equity front, we are not really making many changes right now. I think we've done a lot already, and are generally comfortable.
Yeah, sure. And as you alluded to earlier, we are sort of overweight Asia and emerging markets. So
yeah, that's a slightly longer term thing there. And I mean, shorter term, we are actually slightly overweight the more sort of defensive areas of the markets, and then building on that outside of equities using mid to long term government bonds.
And yes, Sanjay, same question to you, I guess.
Yeah, so high level, without going into too many specifics, of course, the bond market continues to provide us with great opportunities. Like I said, the whole CS debacle, where the AT1 bonds were wiped out, we used that as a great advantage to go out there and start picking up stuff that was cheap. But more importantly, like I said, if you look at it from a high level perspective, where we were this time last year to where we are today, it's been a journey, it's been a transition. The portfolio looks very different, but it didn't happen overnight. It took us 12, 14 months to do it. And if I could request our viewers to look at the portfolio in sort of a 4 quadrants point of view, and this time last year, or January last year, we were positioned at the top right-hand quadrant. And what I mean by top right-hand quadrant, I mean we were exposed to high quality businesses. We were exposed to large companies, so not mid or small in the main. And we were exposed to what you and I would call high growth. And when we look at the portfolio today, the changes that have been brought in, we've now at the top center of that grid. And what does top center mean? We're still exposed to high quality businesses. We're not going to compromise on that. We're very much exposed to large companies, because we realize that the smaller businesses today, there is a risk, and the cost of borrowing is going up, and access to money has certainly diminished. But where we have moved is we moved away from high growth to what you and I would call core growth. So it's very much, for want of a better example, moving away from a Tesla to a Unilever. That's where the portfolio has shifted over the last 12 months, and it's worked out quite well. The other thing I'll say, and then I'll stop, because I know we're running out of time, is the fact that always try and focus your efforts when you're constructing portfolios on areas where central banks and central governments are focusing their attention. So for the last decade, they were buying bonds. So it doesn't matter what bonds were yielding, you would have done okay up until the repricing last year. Right now, I think Mo touched upon this, alluded to this, central governments are spending money aggressively on the green agenda, the energy transition. That has a massive chain when it comes to capital expenditure. Just to build a nuclear reactor, new solar plants, focusing on different aspects of renewable energy is very, very capital intensive. And there are lots of businesses that come within that chain, and they're all going to be privy to certain form of subsidies over the next few years because the governments have pledged telephone numbers, and we want to take advantage of that. So another area that we're homing in and looking at is those spaces where the government is focusing their attention.
Thank you. Well, as I said, we're just coming to the other time. We did have a couple of questions come in, so I thought I'd get to those briefly just before we finish. And the first one was actually going back to China, and given the reopening that we have seen in the last few months, and what we saw in developed markets with the reopening, and then the inflation that has now ensued, is it a possibility that you will see the similar sort of inflation in China over the coming months? And does that pose a risk to Chinese equities?
Should I go first?
Yeah, please, Sanjay, go for it.
The risks of that happening are quite low for a number of reasons. First and foremost, China is coming out of a lockdown at a time when policy has tightened quite a bit in the West. So we're slowing down over here. So it's not that we're all coming out of a lockdown at the same time and there's going to be heightened demand, increased demand, and China's going to have a super boom. No, they're having a boom domestically, but the rest of the world is not having a boom. So you won't get the same inflationary pressures. The other thing is to actually do with the property market. The property market has a massive bearing on how you and I spend. If our properties are worth a lot of money, we have a lot of confidence. China's coming out of a lockdown at a time when their property prices have fallen between 20 and 30%. So that confidence that we had when we came out of a lockdown and we saw property markets just can take off and people were buying properties with cheap money, free money, thinking after the pandemic interest rates will never go up. Very, very different dynamic and the way people think. So again, there's another reason why you'd think that the same inflationary pressures won't apply. And finally, let's not forget the quantum of stimulus that was injected into each one's pocket. What we were given over here in the West and in the US, arguably China has done none of that, right? So when you're looking at what you and I would call the savings rate, so that's the cash in bank after all your fixed bills, it's not as high there as it was over here. When we hear multi-decade highs when it came to savings rates. Savings rates went up to the teens, and normally it's between 4 and 5%. So we had a lot of surplus capital that went out there. And the final bit was China's coming out when supply chains are improving. We were coming out when supply chains were right on their knees. So people were happy to pay more for a particular good because they had saved so much money. So you can clearly see I've highlighted 4 or 5 reasons why things may not, or a policy direction may not be similar to what we witnessed over here.
Do you have any points to add there, or?
No, nothing to add. And I think maybe just worth going on to the next question, just in the interest of time. I think.
Yeah, sure. And I'll come straight to you, Mo, with this then. Again, it's to do with gold, and a position we've held in portfolios for a while now, and something that has performed well in recent weeks and months. And perhaps you give your thoughts on the recent outperformance. Yeah,
sure. So gold's a funny one because clearly last year lots of expectations around gold, and the high inflation environment, and that usually gold does quite well there. Clearly it didn't do very well. I think it was generally sort of flat last year. However, what we've seen this year is the differential between expected interest rates and levels of inflation, and given the sort of SVB issues that we saw, there was quite a big adjustment there between those two figures, resulting in an uplift in the price of gold. So that's why we've seen a bit of a rally this year. And I think base case for me at the moment is that I think that gold could actually end up going a lot higher from here over the coming year or two. For the exact same reasons that I think interest rate policy is going to become dislocated from overall inflation levels. So personally, I'm quite sort of positive on gold, and I know Sanjay mentioned Bitcoin earlier, and I think that maybe a similar sort of argument could be made there. Not making any predictions on that one, but those sorts of assets. Potentially, certainly gold, I think, and just as a sort of slightly broader point, commodities in general. Again, back to the ESG point that sort of race to net zero. there's going to be enormous demand for lots of commodities, particularly copper, etc., lithium. And so I wouldn't be surprised if we saw a sort of multi-year bull market in those particular commodities, and any companies that are associated with those and any countries that are exporting those particular commodities as well.
So did you have any quick thoughts before we finish?
No, except that don't take the last decade as a normal climate, and certainly don't take the last 12 months as a template for future market performance. When you're looking at asset classes, making assumptions, looking at returns, we tend to look at 50 to 100-year averages, and that normally holds one in better better stead than trying to pinpoint a small period.
Great.
Yeah, I think that's brilliant. Well, Sanjay, thank you so much for joining us. Really appreciate you taking the time to speak with us. Speak to our clients, and Mo, as always, it's great to hear your thoughts. And as always, thank you everyone for joining as well. If you have any questions or anything you want to follow up with us, please get in touch with myself or Mo or any of your advisors here at Carrington, who would be happy to answer any questions. So Mo, Sanjay, thank you.
Thank you very much, Sanjay. Thank you.
Thanks,
Thank you, everyone.
Bye-bye, everyone.
Take care.